Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Be taking a look at my normal Tuesday trade. Today on the Schwab Network, it was Tesla. They give me the topic. I come up with a trade based, as always, on implied volatility, fundamental, and technical analysis, taking that fusion approach. So let's jump in and take a look. First, here's the implied volatility on Tesla. As you can see, getting to the lowest levels of the past 12 months, which means option price is getting cheap, both puts and calls. You can see hovering right off the lowest levels of the year, came down from yesterday to today, right? Red was yesterday, today, Tuesday, in green here. You can see on a generalized kind of at the money 25 delta combined IV trading at the lowest level, right, over the past 20 days. So option prices certainly getting cheap, which means you can get into trades at a much lower level that are structured with a long vol and long option approach. You can see the current IV percentile at only 3%. So that is certainly very, very cheap. That alludes to what we looked at up here, where IV at pretty much the lowest level over the past year. This is saying over the past year, it's only been cheaper 3% of the time. You can see it did drop from yesterday to today across the entire term structure volatility. And then taking a look at a generalized IV. Here is kind of the 30-day, kind of at the money 40 delta put, if you will. You can see the IV also hitting the lowest levels basically we have seen over the prior 6 months. So this means option prices are very cheap. You want to lean to option buying strategies to structure trades. In this case, because of the other inputs, right? Valuation certainly, and the technicals leaning bearishly. So we can jump in, take a look at valuations. I took a simple price to sales chart, right, for Tesla. Certainly PE is just ridiculous numbers. Most of the numbers are. But this one, as you can see, a 3-year price to sales for Tesla, now at by far the highest reading over the past 3 years, approaching 17 times price to sales. The only other time in the past 3 years where it was over 15 times price to sales, right, and we're higher now, was back December 24th of 2024. We'll take a look in a second what that date kind of signaled as well. But certainly valuations getting very rich indeed. I also like to do kind of my own, if you will, valuation. So pulled off Tesla's market cap. It was down today. Yesterday, it actually closed over 1.6 trillion market cap. Today's drop 1.52 trillion, but certainly a rich valuation just on a number alone, right? Here's the deliveries, right, over the past 10 years or so. You can see lagging certainly the past several years as far as deliveries, and Tesla at its core still a EV car company. Yeah, they got robo-taxi, yeah, they got AI, all that stuff. That's way down the road. How much will they be able to monetize that? But I think the best thing to look at is take a look at on a delivery of their EV basis. So you can see delivery is a little bit lagging, right? So for full year 2025, everyone kind of expecting about 1.66 million deliveries overall as far as number of cars. That's basically car sales, right? Deutsche Bank a little bit less. And for 2026, right, next year, right, expecting an increase, the consensus, to 1.86 million global vehicles. That's worldwide. So I simply took the numbers and kind of came up with, okay, how much per car are they valuing the company at, right? So I took the market cap of Tesla, 1.52 trillion, excuse me, hard to even say that number sometimes. And I said, you know what? Let's say they deliver 2 million cars. Expectations are for 1.86. I'll say, you know what? Say they beat it very decently, right? So taking that, that still values the company at $760,000 for each car delivered next year. Yeah, $760,000 per car. I think that gives a kind of different look at it, a good way to put it in perspective. Certainly robo-taxi, autonomous, AI, all the other stuff will maybe not, who knows, add to it, but for the time being, that's what you're buying when you're buying Tesla up here, how much you're basically valuing each car at $760,000. So rich to say the least. As we said, IV certainly has gotten cheap, about the cheapest level over the past 12 months. And taking a look at the chart here, right, we can see the last time price to sales were over that 15 times, right, when we kind of took a look at the valuations here, right, when price to sales back in late December of last year were over 15 times. You can see that marked a significant short-term top in Tesla, and also basically the highest level we have seen in Tesla until just the past couple days. So I simply think that is also a signal things may be getting a little bit rich here, certainly on a technical basis, not egregiously overbought, but everything towards the upper end. 9-day RSI well over 60, MACD still hovering deep in the green, Bollinger percent B still approaching 100, right? All of these weakening slightly, stock trading at a decent premium to the 20-day moving average. So the technicals point towards maybe the stock due for a pullback. And I kind of like the action over the past couple days. If we kind of shorten this up, tried to make a run and trade over 500, right? So 498.83 did not hold that reverse and basically closed unchanged yesterday. Today couldn't even make a move higher, reverse and close lower on the day. So running out of steam, to say the least, I think, on a technical basis for Tesla. And taking a look at that IV, as we said, which is at the lowest level compared to, this was kind of the last time we saw the stock up here. I did a simple comparative, right, to that last time when we saw the stock trading at those, highs up there, right, which, was the last time was also valued at over 15 times. So I went back to December of last year and kind of did a comparative. So the stock on December 17th closed at 479.86, basically about $5 lower than where it closed today, right? So I took the puts right from there to compare them to today. But back then I used the 440 put. I'll be using the 450 put to compare it to today. So the 440 put closed at 1675, as you can see. 1660 bid offered at 1690. It was out of the money by almost 40 points, right? Or a little over 8% out of the money. Days to expiration 23. Here you can see it over here. The IV over 70 back then. That was the last time Tesla was at these levels. Didn't stay there, as we saw, for too long, right? That stock absolutely then pivoted and headed lower. So that kind of leads to a little bit of caution as well. Compare that to today's close, right? The stock closed at 485.56, about 5 points higher. The 450 put 10 points less out of the money, right? So I'm comparing the 440 back then with the stock at roughly 480 to the 450 put now with the stock at roughly 485. That 450 put 735, so it's fully less than half the price of the further out of the money 440 put back then. You had 1 day less back then as well, right? So back then it was over 8% out of the money, now just a little over 7% out of the money. Why is that? IV now at 43 and change compared to over 71 back then. So certainly option prices, right, are much, much cheaper now versus back then when the stock was basically at the same level, right? You can take a comparative and simply do how much does that option compare to the stock price, right? Take the price of the option divided by the price of the stock, and you can see it's roughly 3.5% the stock price to basically get some downside coverage on. Compare that to today, right? Simply take the price of that put, which is less out of the money, right, and divide it by the stock price, and you can see it is only 1.5% that you have to pay to get better protection, right? You're getting, in essence, 5 points less out of the money. Stock's 5 points higher, but the put's 10 points closer, right? So you're 5 points less out of the money, and you have one more day. So certainly options getting cheaper. Also did a quick comparative back then versus now on the 445 put, but did it with a week less to go. So I took the same, day, closing date, right? I compared the 445 put, but with only 16 days to go to expiration, right? Back here, we had the 23 days to go. So I took a week shorter time frame, right? That 445 put, which is basically the same as far as out of the money amount percentage and everything within shouting distance, but you have a week less time. You'd expect everything being equal. With less time, the option should be cheaper, but lo and behold, it's almost double the price of the option today, $735 versus $13.90. Why? Because IV back then was over 70, now it's approaching 40. So that gives you an idea of why using implied volatility always as a key component of your trade makes sense. So the trade today, when I was on Schwab Network, and here's the appearance here. Anyone who's interested can certainly click on these links here, right, and get to either the actual Schwab or my website. But it was a simple calendar spread trade, buying the January 16th, those puts we were looking at, the 450 puts that were so cheap, right? Selling to hedge a little the 450 put that expires a week from Friday, lowering the cost by about $2 and change, right? And I do have the 9th and then the 16th, right, to sell additional options if need be to lower that cost down. But certainly I think buying cheap options, the cheapest they have been in the past year for all intents and purposes, on a stock, right, that is valued at by far the richest it is over the past 3 years, right? And on every basis, that's 750,000 plus per car valuation with the market cap, right? Options at the cheapest level. And you can see the last time it was up here, you're getting in at about half the price. Certainly, I think, was worth a shot here. But as we always say at the end of the day, trading is all about probability, not certainty. Doesn't guarantee anything at all. Make sure you position size properly and get out of the trade when you need to. So until next time, as always, here's the good trading. Take care.